Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Wednesday. These are the stories that set your agenda. Tech stocks lead global equities lower on caution over lofty valuations and ballooning AI spending as Nvidia plans $2 billion financing for Musk's XAI. Gold hits $4,000 an ounce for the first time on concerns about the US economy and the shutdown. Pressure on the president. Emmanuel Macron's rivals in France push for their choice of prime minister, demanding snap elections and even calling for the president's resignation. Plus, BMW cuts its annual guidance on weak sales in China and tariff-related costs, underscoring the headwinds facing German automakers. European futures are flat after modest losses yesterday of around 0.4%. A little bit of caution then rippling through the US equity markets as well. By the end of the close, the Nasdaq 100 was down around 0.5%. But the context, of course, is this $16 trillion rally since the lows of April, powered, of course, by that AI theme. Nasdaq 100 futures today pointing to gains of 44 points. S&P E-mini is looking to add just 8 points so far. And the FTSE 100 here in the UK looking to add 15 points, up 0.2% so far. Let's flip the board and look cross-asset then. The focus on the Treasury curve, of course, as we consider the continuing shutdown in the US. We've been hearing from Fed speakers in terms of the path ahead for the Federal Reserve. Still waiting, of course, for more clarity in terms of when the official data comes out on jobs. 412 right now on the benchmark US 10-year. Euro dollar at 116. Softer then on a stronger dollar in the session today. The euro down 0.3%. And there's gold above $4,000 per troy ounce. Goldman Sachs sees further upside through the end of 2026. And Brent up 0.7% at 65, close to $66 a barrel on Brent. Let's cross over to Asia right now. Winnie Su standing by for a check on the Asian markets, and we're seeing again moves around the yen, but also a little bit of profit taking arguably when it comes to the tech stocks of China. Winnie, what are you looking at?
Yeah, exactly. We're seeing a bit of a pullback in Asian stocks today, and that is really dragged by the declines in tech shares, as you mentioned earlier, Tom. So it is that concerns overall about the high valuations and if expectations can really translate to the revenues as we head into the earnings season. Now, Hong Kong stocks down a little on that as well, as we just got back from a holiday. But we are still waiting for the onshore markets to reopen tomorrow. Now, Vietnamese market, we don't usually talk about it, but we are seeing that it's pairing a bit of an earlier gains, but we were up about 3% or so earlier today after FTSE actually upgraded the market to emerging markets. So that is really encouraging foreign investors to pour back into this market. Now, we take a look at what's going on cross asset. We just talked about the yen, but when we look at what's really being driving the losses here today, it's really the Kiwi dollar down because of that surprise rate cut by the central bank by 50 basis points. And we were expecting just 25 basis points. So that was quite a surprise there. While we are also seeing weakness in the yen now at around 152 levels against the dollar. And that's already extending its declines for a fifth day. Still on Takaichi's win and how investors are still dialing back expectations for the Bank of Japan to raise rates this month. Now, when we look at lots of news going on with Asia's central banks, we are still waiting for Thailand's central bank to also announce its potential rate cuts later today. Now, we take a deeper dive into what's going on with tech shares, specifically in China. We do see that overall market HSCI down about 2% so far this week. So if we continue to go with that decline at this pace, we might see that the index will be at its worst week since August. Now, it is a bit of a cool down when it comes to the AI enthusiasm, and we are seeing tech shares, specifically Alibaba, Baidu, also still leading the declines there. The trip-related stocks are also down because we're seeing a bit of weakness when it comes to the spending data for the holiday.
Okay, Winnie, thank you very much indeed for that update, of course, on the Asian markets, joining us, of course, from Taipei. Let's get more in terms of the AI theme, the tech story that Winnie was mentioning there, because Bloomberg has learned that Elon Musk's XAI startup is raising more financing than initially planned, including an equity investment from none other than Nvidia. Sources say its ongoing funding round has now reached $20 billion. Let's bring in Bloomberg's Asia tech correspondent Annabelle Drulers, who's been covering this for us today. Annabelle, what for you then stands out? What are the key takeaways from this financing deal, bigger than expected, and of course the role of Nvidia?
Yeah, well, they're the two key things, Tom. I think you've got that size, so it's interesting because just at the end of September, we were reporting on this funding that the XAI was looking to raise, and we were reporting it to be $10 billion being raised at a $200 billion valuation. And now, just a couple of weeks later, we've had this Bloomberg scoop just in the last few hours talking about $20 billion being raised instead. So it's doubling, essentially, in the space of just essentially a few days. But the story, as well, as you said, Nvidia is looking to invest. What we're hearing from sources is they could be looking to make an equity investment worth as much as $2 billion. So it is very much a massive capital raise for the company, and comes against a backdrop of what has been a lot of investments in AI infrastructure, because just this week we had Oracle into AMD. We've seen Oracle as well raising debt to fund its infrastructure. Meta's been investing heavily in data centers. So there are concerns about sort of the circularity of this deal yet again. Nvidia investing into a company that will then in turn buy Nvidia GPUs, but at the same time, it's certainly caught the attention of many.
And the structure of the deal as well, Annabelle. I know you've been looking at this in terms of Nvidia's commitments and what it could mean, particularly around the SVP, or the special purpose vehicle, SPV, I should say. What is the structure? What kind of is unique to this? What does it tell us about the relationship between Nvidia, XAI, and others involved in this financing deal?
Yeah, it's really fascinating, actually. So, as I said, what we're hearing from sources is they're looking to raise around $20 billion. So, of that, around 7.5 billion we're expecting to be equity, and then the rest is going to be debt. And what sources are telling us, as you said, it's going to be structured via an SPV, or a special purpose vehicle. That special purpose vehicle is then going to buy the Nvidia GPUs, and then XAI will lease the Nvidia GPUs from the SPV. So that's going to be a way for Wall Street investors essentially to recoup some of their investment. What's also interesting about the deal structure rather is that the debt is going to be backed by the Nvidia GPUs rather than XAI. And so the sort of like reading through this or extrapolating from it, it is an interesting playbook, because maybe it's a way that tech companies go to sort of lower their debt exposure.
Okay, well, the complexity is there, and Annabelle, you just did a great job of explaining and breaking that down for us. I know you've been looking at Oracle as well. What's been putting pressure? Why the drop in shares for Oracle?
Yeah, this is a really good one today as well. I mean, it's been good in terms of we're seeing quite a sizable market reaction. But essentially, the story here is reporting from the information, and what they say is that they've seen some internal documents that look at the revenue that they're generating from their server rental business. So what they're saying is that in the 3 months ending August, they generated $900 million from server rentals, but the gross profit was $125 million. So it's $900 million revenue, but only $125 million profit. What they're concerned about, or what they're saying, is the margin on this business is not very good. And so that really led into the drop that we saw intraday, which was down as much as 7%. The stock still did close up 2.5% in the red, so it reversed or recovered a lot of its losses. But then we have analysts like our Bloomberg intelligence team, for instance, that say Oracle has always run this business on slim margins. They're unlikely to change their pricing structure moving forward. But again, we've seen the market reaction, and it certainly played across into some of those big cloud names in Asia today, like Alibaba, for instance.
Okay, the read across is there from Oracle. Bloomberg's Annabelle Drulers, thank you very much indeed for all the details on those key tech stories for us this morning. Meanwhile, in the US, in D.C., President Trump threatening to block back pay for some federal workers once the US government reopens, saying some, quote, don't deserve to be taken care of. The White House Budget Office argues a law guaranteeing back pay is flawed, but Democrats call that interpretation an outrage and illegal. It comes as gold hits another record on market angst linked to the shutdown. Bridgewater founder Ray Dalio says gold is certainly more of a safe haven than the US dollar.
gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold, because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down.
Okay, let's bring in Bloomberg's Valerie Teitel. Val, how should we be thinking about the continuing gains for gold and what it says about the US dollar?
What a momentum trade for the yellow metal. Gold has now risen, Tom, over 20% since the dovish shift from the Fed back in Jackson Hole back in August. In just 6 weeks, added 20%, crossing 4,000 for the first time ever. It crossed 1,000 during the monumental Fed easing during the GFC. It crossed 2,000 during the COVID pandemic when the government started sending out stimulus checks. It crossed 3,000 on Trump tariffs and the worries back in April, now notching 4,000 for the first time ever on, perhaps, as Ray Dalio mentioned, a diversification trade away from the U.S. dollar. But, Tom, if you look back on the winning trades this century, gold really takes the crown. You might as well have just turned off your Bloomberg terminal, shoved it all into gold, and opened it back up today. But gold has really outperformed since this century. And the interesting thing about the session yesterday is that gold is rising, even if the equity market is up or down, even if Bitcoin is up or down. Very interesting to see that both Bitcoin and the S&P 500 were in the red yesterday, but it didn't stop gold from notching another 1% gain. We've actually now snapped that winning streak for the S&P 500. It was on a 7-day winning streak that ended yesterday on the worries, as you mentioned, around the tech trade. But look, it has added 16 trillion since the lows in April. Ray Dalio, as we heard from there, did call the market frothy. But, Tom, it's really hard to turn these momentum trades around in a substantial way with the lack of government data in order to change the needle on the narrative.
Okay, I think there's a disclosure, an important disclosure, Val. There's no way you would turn off your Bloomberg terminal even for a day. I think that's important to know. Bloomberg's Valerie Teitel on the market implications around the gold rally. Val, thank you very much indeed. And a reminder that Mike Johnson, talking of the shutdown in the US, the Speaker of the House, of course, will join Balance of Power later tonight. Meanwhile, to politics in France, and today marks President Macron's deadline to save his government after his prime minister quit. This as Macron's rivals are turning up the pressure on the French president, demanding their choice of prime minister, snap elections, and even the president's own resignation. Our French equity markets reporter Julien Pontus joins us now for the update. Julien, what are we hearing then about these talks and whether or not there's been any movement towards a resolution?
There's been a really big surprising move last night is that the government is proposing to suspend the pension reform, which is something that the socialists, the left, has been asking for. So on one hand, you could say, oh, we might be going through closer towards a center-left government with the socialists or some left-leaning figures. But what will it tell markets today? The pension reform was like a key landmark reform of Macron. When you read the reports of the rating agency, that's one of the things that they say. There's been a few reforms, structural reforms, and the pension reform was one. So if that one is suspended, that could really have big consequences on French debt, on French equities. So it's something that we'll be monitoring very closely. And of course, there's still the possibility that Macron, who could call fresh elections. In France, when the president wants to call fresh election, he needs to consult the president of the Senate and of the National Assembly. He did that yesterday, so that triggered lots of speculation that, indeed, maybe he was going to go through another dissolution of the National Assembly, possibly tonight, or even because his former prime minister and former key ally, Edouard Philippe, actually, it was a bit of a bombshell, suggested he could resign in a few months to pave the way to fresh elections in an orderly fashion. So as you see, there's lots of things going on. The situation is very moving. The Prime Minister, Le Cornu, is hosting the Socialist at 10 o'clock at his office. So it's really, a lot of things are happening at the time.
Okay. Julien, a really important update. Thank you as we count down to that deadline later today in France. Julien Pontus with that update. Thank you. Here's what else to think about then today, as well as French politics. 7 a.m. UK time, German industrial production. We'll get that data for you. And later today as well, the IPO of Verisure in Sweden. At 7:05 UK time, there will be an interview as well with the CEO of that company on listing day for Verisure. And at 7 p.m, we will get the minutes from the last Fed meeting, of course, and we'll bring those to you. Coming up, Jamie Dimon says he would welcome a change to quarterly earnings requirements. More from my exclusive interview with the JPMorganChase CEO and chairman. That is next. This is Bloomberg. JPMorgan CEO Jamie Dimon has told me he would welcome proposed changes to ease US Securities and Exchange Commission requirements for quarterly earnings reports. Here's part of my conversation exclusively with the head of JPMorgan.
I think the bigger problem wasn't just reporting quarterly. It was forecasting where, CEOs get their back up against the wall. They have to meet these things, earnings, and they start doing dumb stuff to meet earnings and that kind of public pressure. I think it's a smaller part of a much bigger problem. We've gone from 8,000 public companies in 1996 to like 4,000 today. And, that, I'm not sure that's good. We drive companies out of it. We have cookie cutter governance. Some activists are good, but they're activists. There's litigation. There's cookie cutter compensation. There's very expensive listing. There's disclosure rules, which you've heard about them here. I mean, endless rules, and that it makes it hard for a small company to go public. So I think, and they're trying to do that here, have an active small company going public. That's what we all need, and create an equity culture, which Rachel Reeves was trying to do here. And I think they're doing a good job reducing regulations, trying to make it easier to do business, and reducing regulation in banks, but also in business in general. You want an active market, and we've kind of crushed it. And because the research laws and MiFID and disclosure requirements. So if I was a regulator, I would take a step back and look at the whole system and say, how can we improve it and make it safer? And look at it holistically as opposed to, just everything's like a one-off conversation.
I need to talk to you about some other changes that the Trump administration has taken. You are a champion of capitalism and free market capitalism.
Yeah.
So when you see stakes taken by the administration, or the US government, let's put it that way, in terms of Intel, golden share for US steel, investments in a lithium mine producer, how does that sit with you?
Yeah. So the first thing is there are legitimate complaints around trade. So just take that first. Some are around just unfair trade. It's unfair to use, it's not just tariffs, it's surpluses, it's capital, it's quotas, it's just, it's the non-tariff barriers. And then there's national security related. So I think in national security, you have to take some special thing. I call it industrial policy, but it's got to be done right. It's got to come with permitting, no virtual signaling. And so like the deal that was done for MP, I thought they did a very smart thing. They're giving MP, which we were part of banking, does rare earth magnets, because they're going to have a long-term contract with the government, it gives them a chance to survive, to get through it. They call it the valley of death. And they bought a piece they're going to do that. So I thought that was really well done. I'm not going to comment all of them. I think you have to be very careful when you get involved in that kind of stuff. Why are you doing it? What's the long-term benefit? And then, of course, if Democrats get in power, they're going to do even more of it. So I would be very cautious about how you go about that. I do think they need to do more. You cannot do certain things in the United States. You think a company's going to do it, they'll be bankrupt in 7 months. They either need free land, cheaper financing, and maybe the most important thing is long-term purchase agreements with defense or companies or something that gives them a real chance to build a business.
You touched on the fact, look, we're here in the UK. The Chancellor's here. She addressed the summit. She addressed the conference. She's making those changes. Is the UK doing enough? There are going to be potentially some changes when it comes to listings. They may be announced in the budget in November. Is enough being done to make the UK, to make London an attractive listing destination again?
Well, first of all, something here, it's a wonderful city. It's a melting pot. The brain power is extraordinary. And I'm talking about not just financial, but lawyers and technology, media. It's unbelievable. It's a huge benefit to UK, though I'm not sure the rest of the UK appreciates that much. And they're saying the right things. They're deregulating. It's not just banks, but business in general, reducing red tape. I call it blue tape now. They're reducing red tape, blue tape. They're trying to consolidate the pension and savings schemes, which I think is very smart. Have a little more of an equity risk culture. Not to lose money, but to take a little more risk. And maybe some of these tech companies here, I applaud everything they're doing.
JPMorgan CEO Jamie Dimon speaking exclusively to me yesterday. Coming up is an IPO on the cards, meanwhile, for fintech company SumUp next year. Bring you an exclusive interview with that company's CFO. That is next. This is Bloomberg. Welcome back. UK fintech SumUp is potentially exploring an IPO next year. I had an exclusive conversation with the company's CFO at JPMorgan's Techstars conference in London.
We've been very fortunate that we've had access to pools of capital over the life cycle of SumUp. We've been around for 13 years, and over that time, we've had huge interest from investors. As I say, we're now cash flow generative, and so, access to capital is not necessarily a problem for us. That being said, as we continue to move forward and we look at the payments landscape and the software landscape in Europe in particular, there are a number of players out there that have grown up over the last several years, but that simply won't be able to scale. And so consolidation is a key dynamic within payments across Europe. And given that SumUp's been able to grow to this scale, SumUp has a really important role to play as a consolidator, changing the face of what that industry looks like across this space. And so as we look towards that, the opportunity for having a listed security as a currency in that activity is an attractive one that we continue to consider. But in the meantime, we're very focused on continuing to build that cash flow generation, continuing to build top-line momentum, and having relationships with all of those investors that we're seeing here today and that we continue to build relationships with.
Let me push you a little bit. 2026, it's possible we could be looking at an IPO for SumUp in 2026.
For us, it really comes down to what does the market look like against how do we want to continue to invest our own money. So it's a little bit of an investment consideration. What does that investment look like for us in particular? Where are we seeing that ROI? Is it in M&A? Is it in continuing to acquire customers in an organic manner? And then against that, what does the market environment look like? Obviously, the market environment over the last 6 months has been variable, to say the least. And so, we continue to observe that. I think there are some really exciting times in the market, and that plays a role in our decision making.
Is there a listing destination that's top of mind for you now, London versus New York or somewhere else?
Again, those discussions continue. This continues to be an area of discussion for us at the board, across our investor base. There are certain preferences that evolve, but for us, there's so much optionality out there that we're very fortunate to be able to have our choice should we decide to go that route.
Okay, the CFO of SumUp, Hermione McKee, speaking to me at the Bloomberg Techstars conference in London yesterday. Meanwhile, the UK's Financial Conduct Authority says it now expects some of the country's biggest auto lenders will spend £8.2 billion to compensate customers who are missold car loans, including the cost of getting the refund programme up and running. The FCA says the total cost is likely to be £11 billion. Lower than the midpoint previously provided. The agency now expects average compensation of around £700 per consumer. Coming up, German car maker BMW, meanwhile, cuts its financial guidance for the year. We'll bring you that story next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tech stocks lead global equities lower on caution over lofty valuations and ballooning AI spending as Nvidia plans $2 billion in financing for Musk's XAI. Gold hitting $4,000 an ounce for the first time on concerns about the US economy and the shutdown. Pressure on the president. Emmanuel Macron's rivals in France push for their choice of prime minister, demanding snap elections and even calling for his resignation. Plus, BMW cuts its annual guidance on weak sales in China and tariff-related costs, underscoring the headwinds facing German automakers. Now, remaining on the industrial space, ABB, of course, the Swiss maker of robotics, and with a big focus, of course, on industrial solutions. The redhead coming through across the Bloomberg terminal, ABB to sell its robotics unit to Softbank for an enterprise value of just shy of $5.4 billion. The lines include some details around the cash proceeds, net transaction costs of around $5.3 billion, the divestment to result in a non-operating pre-tax book gain for ABB of $2.4 billion, and that the robotics unit divestment to close mid to late 2026. Continuing to bring you the breaking news because we have Verisure offering the price for its IPO set at €13.25 per share. The listing in Amsterdam, of course, this is the home security company and what is set to be one of the biggest IPOs in Europe of the year. So that's Verisure offering its price offering for IPO set at €13.25 per share. We will bring you an interview with the CEO of Verisure at 7 a.m. UK time, so stay tuned for that conversation. Here's another redhead for you as well. Cristiano Ronaldo has become football's first billionaire. We'll bring you more on that maybe throughout the next couple of hours. Let's get to the markets, though, right now, because European equities look to be eyeing the next catalyst. Flat right now in terms of the futures story after a little bit of softness across European stocks yesterday. Here in the UK, the FTSE 100 is pointing high by 0.2%. S&P E-minis after dropping around, 0.4% yesterday, currently pointing to very modest gains of 4 points. Nasdaq 100 futures point to gains of 0.1%. Let's briefly check in across asset then. We're seeing the weakness continue in the yen, but for the euro, there's also softness on dollar strength, down 0.3%. The benchmark 10-year is yielding 4.12, and gold remains above that $4,000 per troy ounce level, up 1.3% in the session today. Let's get more on the markets with a lens on the UK and bring in Laura Foll, Global Equity Income Team Portfolio Manager at Janus Henderson. Laura, great to have you around the desk this morning. Thanks for coming in. When it comes to the UK equity space, FTSE 100 is up about 16% year to date. Are the gains for the UK and UK equities looking a little stretched at this point, or are the fundamentals there to support further upside into 2026?
I mean, for me, it always comes down to valuation. So if you look at the UK, that FTSE 100 that you mentioned, we're still looking at a PE ratio that's in the low teens. If we go to the US, it's more like low 20s. So it's still a historically high discount, the UK relative to the US. Europe would be at a discount to the US, but more modest than that of the UK. So I think rather than trying to predict the economy on, say, the next quarter or something, always come back to valuations. That would suggest the UK is still okay. I would say the other thing to look at still is the takeover activity in the UK market. We're seeing really heightened takeover activity in both small, medium and large companies and across a range of sectors. Okay. And to me, that suggests value is still there.
There's a bit to unpack there. On the valuation, there can be the argument there's essentially no tech in the FTSE 100, and that explains it. And therefore, we are not going to benefit with exposure to the FTSE 100 to the upside that's coming through on AI.
So that's an excellent point. And when you sector adjust the UK market relative to the US, there is still about a 20% discount. So even if you do that, if you ignore the different composition of the market, it's a 35% discount. But even when you adjust for that, it's 20%. And actually, every single sector in the UK trades at a discount to the US. So it's a completely legitimate argument, and I hear that. But even when you adjust for it, the discount is still there.
OK, that's interesting. There's also historically been a dividend story in the UK and returns of cash to shareholders. Where are we? How is that picture looking as a catalyst for the equity market in the the UK into next year?
It's been a really interesting dividend dynamic in the UK in that UK companies are very aware of that valuation discount that I just mentioned, and that the flow picture is difficult. So they're shifting their capital allocation towards share buybacks rather than special dividends in particular, but also we're seeing some companies adjust their ordinary dividends in favor of share buybacks. So it's an interesting picture where companies can see that they are lowly valued, the board can see that they're lowly valued, and they're pulling the levers that they have under their control, one of which is the buyback. So the US market has historically been associated with share buybacks, but actually the UK is one of the highest markets in terms of distribution in the world in terms of the buybacks.
Which some can interpret as a vote of confidence from the boards when they're obviously adding to their own pot
you
on that
can see
front.
it, historically, it's been seen both ways, as in, yes, it's good that they're returning cash to shareholders, but you could interpret it in a way that do they have capital investments that are proving good returns, over the long term. Do you see what I mean? It's sort of a double-edged coin. But yes, I think at the moment the UK market is just being pragmatic in terms of its flow environment and returning capital that way.
And you talked about the acquisition story, and I was at the JPMorgan event yesterday with Jamie Dimon and the team there, and they were talking about the role of private equity and how they expect to see a big tick up in deal making. The UK will be a part of that, and it has been a part of that already, with some companies being taken private and some private companies being taken over by private equity. To what extent is that potentially a factor in 2026? Does that pick up next year?
I think for as long as we see that valuation discount, the takeover activity is likely to continue. There is an arbitrage that can be done, whether it's by private equity or whether it's by overseas peers. We've really seen a mixture of the two in terms of that takeover activity. So yes, I would think companies are rational actors. Private equity is a rational actor. We saw the bid for something like a Spectris earlier on this year that was at an over 100% premium. So I think there's a real solid evidence that there is this valuation discount here, and I think we'll see that continue.
The budget, November. What are you watching for when it comes to that lens that you have on UK equities?
So the key thing that's in the front of my mind for it is there will be tax rises, I think, and it's about, are they inflationary? So what we saw in the budget last year is that the way the roughly 40 billion was raised meant that UK inflation ended up higher this year and has decoupled from, say, the rest of Europe. So when it comes to the budget, if we're talking, say, 25 to 30 billion in terms of tax rises, that's not huge in the context of a roughly 3 trillion economy, but it's about whether those tax rises are put through in a way that's not disruptive and will allow UK inflation to recouple with Europe and therefore interest rates to come down as we look to 2026.
OK, that's really interesting. So that's key as the market's pricing, I think, just 35 basis points between now and September of next year for the BOE, but maybe that changes on the budget with that focus on the potential inflationary impact or not of whatever measures come through. Laura, thank you very much indeed. Really fantastic conversation in terms of how to think about the UK equity story with all of those factors tied in. Laura Foll, Global Equity Portfolio Manager at Janus Henderson. Meanwhile, BMW on the corporate space, shares indicated lower on TradeGate after it cut its financial guidance for the year on weaker sales and tariff-related costs. Joining me now is Bloomberg's China Cars reporter Linda Liu, because, of course, a big part of this is down to the China story. Linda, thank you for your time. Why are Western manufacturers like BMW losing ground on sales in China? This isn't a new phenomenon, but it seems like this trend just continues, consumers in China pulling back.
Yeah, you're right, Tom. Essentially, under this really rapid transition to electric vehicles in the China market and the rise of domestic champions such as BYD, a lot of the customers in China now are preferring to buy, local brands instead of the foreign brands such as BMW, Mercedes, or Audis that have really long commanded in segments such as the luxury, high-end market segments. So you've got the Chinese EVs also moving into that space, leading to brands like BMW really losing sales in that area of the market.
In terms of the impact then of tariffs, I mean, clearly there is that impact, and Europe has negotiated that deal with the US, but the tariff impact is being fed through in terms of the cost and the hit on margins. Where does BMW stand on that front in terms of how they've been able to mitigate or not some of the hits to those increased levies?
So I would think that from the guidance, it looks like they probably have to take a hit in 2025 because of the timing of some of that tariff reimbursement. So what BMW has said in its guidance is that they were expecting the reimbursements from US as well as German authorities on tariffs to have come this year. Unfortunately, it's now looking like the reimbursement, which is, I think, in the millions, to come next year instead. So that's actually led the automaker to have to slash their cash flow guidance by half. So originally they were expecting cash flow for 2025 to be about 2.5 billion euros. Actually, currently the new guidance is 2.5 billion euros. That's down from 5 billion euros they had originally forecast.
Linda Liu, thank you very much indeed with that update in terms of the China impact on BMW and, of course, the tariffs as well. Really appreciate it. Thank you. And that is a stock certainly to watch at the open. BMW called lower. Sticking with autos, Tesla shares also falling as it introduced cheaper versions of its top-selling models in a bid to counteract the loss of US incentives for electric cars. The new standard versions of the Model 3 sedan and Model Y are priced at under $40,000 with less battery range and stripped features. Tesla's global sales have fallen around 6% this year. Plus, the major effort to ramp up funding for Europe's quantum startups. We're speaking to one of the backers for what claims to be the world's largest VC fund dedicated to investing in quantum. That's coming up. This is Bloomberg. Right, to quantum computing now, and a major effort to ramp up funding for Europe's quantum startups. 55 North claims to be the world's largest dedicated quantum technology venture capital fund with a total size of 300 million euros, following the recent first close of 134 million euros. Among the fund's backers are prominent quantum and deep tech investors, including VSquared Ventures. The pan-European deep tech fund boasts a portfolio that includes companies like IQM, the exploration company, and Neura. Very pleased to say joining me now is Herbert Mangesius, VSquared Ventures co-founder and general partner. Herbert, good morning. Thank you for your time. Talk to us then about the importance of this quantum fund. What is the rationale behind it? Why now? Why commit so much capital to quantum computing?
Thanks, and good morning, Tom. So first of all, I don't think it's so much capital. While it is the largest quantum technologies-focused fund in the world, if you look into the market caps of the big firms and what's going on in the sector and how it has been accelerating over the past few years, this is still probably too little. But it's a very good start, and it's a very great team. And it's also very important that this fund is anchored in Europe and has also a European mandate, can invest globally. And Europe in particular is the continent and the place on this planet where a lot of the innovation that has been turned into products actually comes from startup companies, which is different from what we see in the US, for instance, but also in Asia, where innovation comes from large tech companies.
Okay, interesting. So, Herbert, just on that point around funding, how big is the funding gap that remains then?
Well, in the end, this really depends about how you look at the industry, right? And you want to support this industry. And venture capital is good for times where there's uncertainty and large industrial firms not investing. While you see in the US, companies like Microsoft or Google or IBM, they have massive programs, right? So they do invest a lot of money. Here in Europe, this is not the case. So our companies in semicon or broadly in computing do not invest. So I was saying, I think this fund still is too little. We need growth capital, that's clear. But if you look into the venture market and you come from the bottom to the top, you see that there is a lot of seed capital, pre-seed capital available in Europe. And there is the first gap that we need to start closing in Series A, Series B. So at the point where you turn technology into products and bring them into markets. And this is exactly the role of this quantum fund.
Well, and on that point then, Herbert, when do we get, because we get the research stage, we're seeing quantum initiatives, at least quantum computing being applied in some areas, and HSBC most recently coming through with some success there. When do we see it, though, applied at scale and have a material impact on business outcomes? When is that, in terms of the time frame, what is the proposition?
Well, I think those points in time, they differ, right? People say it's within the next 2-3 years. Some say it's 5 years. But the common sense is that we don't, this is an engineering roadmap. So we know what we can do, what these systems today can achieve, and there are roadmaps, and we already see that in certain cases, quantum computers are better in the results they can produce than classical computing in terms of precision, how you, for instance, simulate molecules. The other thing that you also see big firms in the financial industry, for instance, but also elsewhere, they come with ever new algorithms and innovation, which is not classical in the sense of digital computing, but really quantum native. And you, from top down, you lower the barrier to where you get real quantum advantage, right? So technology is emerging and getting better. So bottom up, you're getting much better, and the gap is closing very rapidly from bottom up and also from the top by coming to better algorithms very, very fast.
And two companies that you've invested in already, at least the fund has invested in, IQM, Series B, and Xetra as well. So you're investing in the quantum computing ecosystem. Just expand on that.
Yes, so that's a very important topic. Also the team, how it's set up, it's really experts from the quantum industry. And what we see in particular in Europe in the quantum industry is that you have platforms, compute platforms like IQM, which are end-to-end. But when you look into the engineering roadmaps in order to create much, much better systems, there are bottlenecks. And one task of the fund is really to get into these bottlenecks in value chains, and look into product companies and innovation that's coming from startups and solve these bottlenecks, right? In order to accelerate the path to real meaningful quantum advantage systems much, much faster than if just one company in itself needs to do that. And there's not one single tool, of course. There's also experimentation, and there are different approaches to different problems. And that's what the Quantum Computing or Technologies Fund is trying to facilitate, right? To enable the whole ecosystem and faster progress overall.
Okay, Herbert Mangesius, VSquared Ventures co-founder and general partner on this new fund, focused squarely on quantum computing. Really appreciate your time, the update, and the details on what's involved and what the potential opportunity is as well. Thank you for joining us. And a reminder, the next episode of Bloomberg Tech Europe is airing this Friday, 6:30 a.m. London time. We're going to be looking at how AI is reshaping the banking sector, with interviews including the CEOs of JPMorgan, Goldman Sachs and Klarna. And, of course, the episode will also go out on YouTube. Now, Cristiano Ronaldo has become the football world's first billionaire player. In the twilight of his playing career, the 40-year-old has been catapulted into the top ranks of the richest sports people, inking a fresh contract extension in June with Saudi Arabian team Al Nassr that is reportedly worth more than $400 million. Joining me now is our Portugal bureau chief, Sofia Horta y Costa. Sofia, great to talk to you about Ronaldo and this incredible wealth. How has he done it?
So what's really unusual about this, Tom, is that actually the bulk of his wealth comes from salary and also mostly from the Saudi move. So it was a really lucrative move for him. Let's not forget that obviously in Saudi Arabia, there's no income tax. So he's benefited from that significantly. But a net worth of $1.4 billion US. Now, most of the billionaire athletes that the Bloomberg Billionaire Index tracks, like Roger Federer, the majority of that comes from sponsorships or ownerships in other companies. But Ronaldo is purely from being on the field, which is very unique among athletes.
And I'm assuming, Sophia, he's not keeping all this money in the bank. Is he investing it? Do we know how active he is as an investor?
So we do know it's quite sporadic, actually. He tends to invest a lot in Portugal, which is why we're looking at this. You know, he's bought a local, very well-known local ceramics company. He likes paddle, so he bought a paddle court chain here in Portugal as well. He's invested in hotel chains, one that's based in his home island of Madeira. But he doesn't really have a kind of formal investing structure quite yet. He does work very closely with a very select group of people. He doesn't trust a lot of people. And one of them is a wealth manager based here in Lisbon, actually just up the road from where I am right now. And he declined to comment for the story, but the thinking is there could be more formal structure going forward. Now, if you ask Ronaldo what his life will be after football, he doesn't like that question because he always says, I am still playing, I am still a footballer, I'm not retired. But he has said that he wants to own maybe one or several football clubs, following in the footsteps of David Beckham and others who have gone down that path. And also Brazilian Ronaldo, let's not forget the original Ronaldo, also owns a club in Spain.
OK, well, he's got the capital to do that. He could move beyond ceramics and paddles to football clubs. Sofia Horto-Costa with what is probably the story, or at least the most fun story of the day, Bloomberg's Portugal bureau chief on the billionaire plus status, of course, of Ronaldo. Thank you, Sofia. There's plenty more coming up. Stay with us. This is Bloomberg.
I said before, the Fed told us concentrate on mass employment, concentrate on stable prices, right? Don't concentrate on the political cycle. Don't concentrate on anything outside of those. That's what I think is important. And I think that part of doing that is actually sticking to the Fed's mandates as assigned by the Congress and avoiding mission creep.
A big question mark for us is this tariff inflation going to be short-lived and then we're going to start trending back down to that 2% inflation? Or is it going to be sticky at around a 3% level? I would just say it's too soon for us to reach any firm conclusions.
Minneapolis Fed President Neil Kashkari, of course, and Fed Governor Stephen Myron speaking then. Of course, the Fed's decision-making and expectations of further rate cuts feeding in to the view around gold. And, of course, we've seen it up year-to-date around 50%. Goldman Sachs has a target now of $4,900 by December of 2026. We're looking at the highest levels for gold since the 1970s, or the biggest gains, I should say, since the 1970s. But take yourself back to the start of the century, and you can see from this chart that gold has outperformed stocks since the start of this century, outperformed the S&P 500 and outperformed global stocks as well. Again, Goldman Sachs targeting 4,900. Is there further upside for the metal that remains today above that $4,000 level? Let's flip the board, going from the central bank thinking around the Fed to the BOJ, of course, with potentially that new prime minister with the dovish tilt coming through. Worth reflecting on the fact that rates in Japan have started to close the gap with their counterparts in the US and, of course, Europe at 2%, Fed at 4.25. Expectations the Fed goes lower, of course, from here, with the markets pricing in 100 basis points, closing the gap further then with the BOJ. But, of course, with the caveat that you could get this more dovish prime minister who could lean on the BOJ, of course. Markets not pricing in the next full cut from the BOJ until March of next year, though December is in play. Now, a reminder, in just a few minutes, the CEO of Verisure joins the team to discuss the security alarm company's IPO today, Europe's biggest so far this year. Plus, Mike Johnson, the Speaker of the House, will join Balance of Power tonight. The opening trade, though, is up next. This is Bloomberg.